by Stephen Nash from FIG Securities in studio with us this morning. And this is interesting. It is, when we've had the improvement in the data in the last couple of weeks, is it worth entertaining the idea of yet more stimulus from the Fed?
Well, I think if you saw the interview, he's quite circumspect in terms of the prospects for the US economy. He's quite concerned about unemployment, and he's very convinced that they'll be able to control any inflationary problem very quickly. Whereas the problem with the deflationary problem they possibly could get themselves into is much more difficult to deal with. So I think that's what he's getting the market ready for.
Mostly a PR exercise, a lot of people would say, trying to basically come out and justify the position. There's been so much criticism. Was it useful? Did it achieve anything?
Well, I think it is very unusual that the chairman should be out. He's written some commentary in the press as well as now come out on TV. So I think it's just indicating, I think, that the Fed has to do more in terms of getting its message out. And I suppose it's partly defensive, but it's also explanatory, so that people really get an idea what the real thinking is.
If you look at those Treasury yields and where they have or they haven't moved, surely that's a lesson in saying, PR exercise or not, it didn't achieve the outcomes. So why not go down the road of more money printing?
Well, I think it was quite a substantial rally as we saw this year, but I mean, there's been a lot of profit taking. People are concerned, I think, in terms of market participants are concerned about an increase in inflation, but I think those concerns are probably overdone. I probably agree with the chairman that that inflationary concerns are really overstated, and that if anything, rates should be quite a lot lower, particularly 10 and 30-year rates.
It's interesting how you relate that inflation story to what our own perspective here with the TD gauge just yesterday. What was your take out from that? Because again, it's mindful to consider the Reserve Bank's view on that, particularly now we're not going to presumably get a monthly official CPI number. That was confirmed yesterday. Well,
the ABS are investigating whether we should have that, and I think they need funding to achieve that, and I think over time we'll get it. I think the RBA is very supportive of that.
Don't you think it's more noise though in the economy, because we get so much data? One guest this morning saying, well, we don't need to be confused with more.
Well, I think aligning the Australian releases with other releases globally and having a monthly indicator, I think would be a good idea. It would possibly be more timely for businesses and for the RBA. I think it would be very good, and having a quarterly release is a bit frustrating. People build up so long for it, and then there's issues with it. So I think it's too historical at the moment.
How do you think the RBA achieves a balance today of expressing, yes, that they're on this path, they've just tightened last month, we know that the bank's tightened even more, and yet we've had that very weak data come through? I mean, they can't come out and be very dovish because we know they just raised rates. How do you think they achieve that balance?
Well, I imagine they'll just continue to focus on capacity issues, and they'll be talking about regional growth, Chinese and Indian growth, supporting that. But I think the retail story is obviously quite weak.
That was just a month-on-month dive. John Kriakopoulos from the NAB is just coming out and saying on Dow that that's way overstating it. They won't be blindsided by one bit of data.
No, I think obviously the RBA are seasoned watchers of this data, and the problem I think was with the previous tightening was that the outsized increase by the major banks. I think they did expect some increase. Whether they expected that full 45 or 40-point increase, I'm not sure if they did expect that. That's effectively a double tightening prior to Christmas. I think, given that double tightening, it would suggest that there's a good case to hold off and just evaluate what's going on.
What about the labour market, though, that looks as if it could be getting ahead of everything else? The job ad series yesterday, when you look at the rises there, that is actually up 32% on the same month last year. Yeah, that's quite a hot number.
Again, we're seeing a lot of differences between the states, particularly WA being quite firm.
But it's still worried about that, isn't it?
The previous employment figure, as everyone was expecting something to punch through 5%, didn't do that. Participation went up. I think that participation story could continue, and that unemployment could hover above the 5% level. There's expectation of 5.2. not really expecting too much on that employment number, and not expecting under 5%.
And those numbers on Thursday, just for viewers' interest.
Yeah.
Do you think that the RBA would be taking into account the developments across Europe? I mean, markets are still troubled by it. Would the RBA be worried about it?
Look, I think over this last month, I think conditions in Europe have materially worsened, and I think even if a tightening was on the cards, then I think that may have been one of the factors to stop them going this month. Generally, I think the consensus is that there won't be a tightening. I think that's pretty fair at this stage.
Glenn Stevens testified a few weeks ago in Canberra, and he kind of made reference to Europe and said, it was almost as if, well, we expect flare-ups from time to time to happen. We're aware of them, but again, they are just pieces in the puzzle. They don't disproportionately occupy our time.
Well, it's whether or not you characterise the European problems as an individual flare-up. I think there's been basically a continued problem with Europe. We saw Hungary getting very close to the bottom of the investment grade rating with Moody's last night, and other countries having continued difficulties. I think it's getting a little bit more serious than that right now. Hopefully the ECB can contain those problems, and I think they've done a really good job with the speech last week. I think that's been very supportive and moved those yields in substantially. But it's probably a little bit more than an isolated situation, and I think it will be borne in mind this time.
And because the ECB did say that they'd be happy with some more unorthodox measures, they could do that if needed. But then again, the markets are more actually troubled by the political, or the lack of political cooperation, which is only, I guess, strengthening the idea of how all of this fracturing came about anyway, the lack of political coordination. How do you think we
it's better than, I think it's better than the Greek crisis, the debate between the various political interests. But Germany's been opposed to any liberalised approach, and I think that's probably going to continue, a fairly hardline approach. But I think overall their approach is improving. It's quite slow, that's all.
Do you get a sense that Germans themselves are resenting being the one to carry the can on this, that Angela Merkel has to now be ever more strident and say no, 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 simply just to appease?
Well, I think the Germans have to realise that there's a lot of benefits from the EU. They derive a lot of exports. So there's a lot of benefits that they receive, and there's also costs. And I think by keeping together, that's what they're going to reduce those costs. And I think at the moment, any restructuring or default of a peripheral sovereign will cause a lot of problems in the banking system. I can't see how they could allow another Lehman-style situation to occur, and that's effectively what would occur, I think.
Do you think they actually do need to increase the size, or how do we know if they need to increase the size of this bailout fund, as Germany's opposing?
I think that the markets will anticipate there could be problems with Spain, and that they may have to increase the size of the fund. I think that's, over time, we'll probably get some sort of increase there. The size of it's an open question right now.
Because you had Trichet in the market buying, as the central bank was buying bonds, but saying in the other breath, no, we weren't, until it was patently clear that they were. Is this sort of like a desperate stopgap? But again, it distorts the bond market because it's not transparent, and we don't really know what's then driving the real price action.
Well, I think someone within the EU has to do something to control what was getting a bit of an out of control situation. I think action of that sort, I think in these circumstances, is probably justified. I think they've been quite measured in what they've done. I don't expect the ECB to go out on an all-out buying campaign of peripherals as if it was a good investment, or whatever. I think they're just acting to control what effectively become a pretty chaotic situation.
What's actually going to, without more ECB intervention, as Carson was talking about, what's actually going to help that situation improve in terms of the spreads, those yields that we're watching rising for?
There has been some discussion of a sort of a Euro-wide issuance of bonds, and there will be some of that anyway next year. Maybe an expansion of that facility where instead of individual countries issuing, the central borrowing authority takes over in emergency situations. I think that's probably a very good idea. It'd save a lot of money for the various.
But in the meantime, is that other conditions for
in the meantime, it's going to be a pretty fluid situation.
That's right.
And it's been very troubling, and I think this is one of the things that the RBA will be pretty concerned about.
Not enough to move on rates, though. Sit tight.
Yes.
Thanks, Stephen. We'll chat to you soon. Stephen Nash from Fixed Securities with the analysis.